Futures and options on futures trading involve substantial risk and is not a suitable investment for all types of investors. Past results are not necessarily indicative of future results. When I use the word I in this video, it refers to what I teach in my charting course or what I author in my twice daily oral and written updates. Prices shown on charts and quote boards are in real time and take into account all known activity up to this point in time. And if you'd like to read more of this disclaimer, simply hit the pause key on your video player. Good afternoon. Ira Epstein of Linn & Associates with your metals market update for this Tuesday, the 11th of July, 2017, about 2:30 p.m. Central Daylight Time. Keep in the back of your mind that tomorrow's important. You get the Bank of Canada, they're expected to raise their interest rate. Janet Yellen speaks before the House Financial Committee. We'll get ideas on her view again of not only when interest rates are going up, balance sheet adjustments. And if I'm one of the House or a congressman in there, I'm going to come out and say, where's the inflation? I mean, what is going on? Are all the links broken? Do things no longer work the way they used to? Maybe because of technology? I don't know that she has all the answers, but somebody should be asking that, because if you think about it, this whole 8-year, 9-year period of easy money, where's the inflation? You tell me that we have full job growth. We're at 4.4% unemployment. Where's the inflation? And that becomes the problem that the Fed is facing. But when we take a look at the gold, you can see today up about $2. Silver gained on it. Copper market's acting much stronger. And this is often a bellwether of how the world markets are looking in terms of industry. And they're still looking, I think, pretty darn good. The dollar dropped a bit, nothing major, but it was supportive to the metals. When we take a look at the gold market, I've got on the weekly chart the 18-week moving average of closes, and there's no doubt the market is under it. Should it get a fire under it and decide to lift up, well, maybe you can get back to that 1251 level. But who's in control of this market right now? Clearly the bears are. When we come to an area chart of closes, sure, there's higher closes up here, but I covered them. They don't matter. What matters are these right here. And they don't matter because you're looking to see what the swing line's saying. And here's the key number for the swing line. This is what you don't want to take out. And by the way, it's not a swing line. These are just the closes, but they look like a swing line. And it's the same principle. You have a pattern of lower highs, lower lows. Until you get back over that on a closing basis, you're in a downtrend. When we go to a bar chart, and I will apply the swing line here, this is what that looks like. And here's your swing line. So we know that on this day, 1229.50 was the high. In order to negate the current downtrend, you have to break the pattern of lower highs and lower lows. That can be done if you take out 1229.50. Would that create a bullish market? No. You'd end up with a lower low and then a higher high. This whole thing has to restructure in order to get friendly. The most you can do is pause the bearish part of the market right now. In terms of moving averages, you keep dropping on this 18-day average, and it's making its run for this number right now. So as prices come up, even if you take out 1229.50, I'm going to expect a brick wall to be hit here. And if you should have, like, I guess an armored truck and you get through that, maybe you get to the 1250-240 level, the 100-day average. In terms of why the market's bottoming, well, you've been running on the lower Bollinger Band, and more times than not, the markets try to get to the right-hand side of that. That's where we're at. In momentum, you still have an embedded reading. By embedded, it means that both these numbers are trading under 20 and they've been going sideways. When the red line closes back over 20, that's going to be a sign to you that the market wants to make a run for that 18-day average of closes. That's because the downside momentum will have been spent. It's not there yet. When you come to the ETF for the GLD, this is the big holding. You have the embedded reading, no change there. You have the clear pattern of lower highs, lower lows, staying to the right-hand side of the Bollinger Band. Resistance, 117.78, and to get there you have to break the downtrend by getting through 116.61. Again, the bears are in total control of this market. The market that they lost control of, the bears, was the GDX.
And we saw that happening yesterday with this good price action. Now the key was if you can take out yesterday this number of 2170, you might make a run for the 18-day average. You got to 2174 today. The market is also not embedded. I'm looking for that 2197, the market to neutralize around there. The gold-silver ratio, as I pointed out recently, the high that it had been was 82.54, as you can see, around January, February of 2016. You got within 4 points of it at 78.42 right now, and the market's starting to finally correct. Silver is gaining on the gold, and it's ahead of the gold in many ways. Number one, it has lost its embedded reading. When you lose the embedded reading, unless you gain it right back the next day, the odds are that price and the 18-day average are now going to make a run at each other. When you look at the copper, you held yesterday the combination of the 18 and the 100-day average of closes. So on this whole break, if you were looking at anything, you're saying to yourself, where might it break to? You had an embedded reading, you lose it. Maybe you go to those numbers, you held it. Today's rally gets up over 267.10. You negate the swing line downtrend. You've neutralized it now. Now you have no trend at all. You have upside bias because you're over the 18-day average. And in terms of momentum, you're pretty flat. It's a difficult market to make a call on. In the platinum market, you're still very much in a downtrend, lower highs, lower lows, but you're not embedded. So maybe the market makes a run towards that 919 level. I think the one thing I'm saying in all the metals is they're more likely to give you a bounce than they are to fall apart again right here. That's probably the best way to sum it up. And you get to see that in a really good way here. This is how we looked yesterday in the palladium. Clearly, lower highs, lower lows. You hit the Bollinger Band for 2 days. You bounced away. The market's looking right here. It's still got an embedded reading. You lose the reading and you go right to that 18-day average, and now the market's got to figure out what it wants to do next. It did not yet get over 849.05, so the swing line's still down, but with the price like that, right at that 18-day average, you've at least neutralized part of the action that's been going on there. The the dollar index became bearish again today, but there's a caveat. It's very oversold. It's not embedded. It's just plain oversold. You now have lower highs, lower lows. That is bearish, and you're under the 18-day average of closes. The trap on this would be taking out today's high of 95.96. Why? The high of an outside day means you took out the previous day's low and high. The high of that, when you close lower, should not be violated according to my rule for 2 business days. If it is, it's a trap. You probably go back to the 18-day average of closes, if not more. So something to be watching on that chart. So when you put it all together, it is exciting. You know, I had one of my brokers talking to me today, said, Ira, on the S&Ps, you had sell signals the other day. Why'd you back off? And I said, well, one of the things I teach isn't that there's anything wrong with the signal. In fact, it would have worked out. Why go into Miss Yellen's speech with any position I might not want to carry? And that was exactly what my reasoning was. So you have to make your decisions. If you're going to be a grain trader tomorrow playing the USDA supply-demand report, you want to play Miss Yellen with what she's doing. There's a lot you always think about, and like I always say, you learn. And one of the ways to learn is reading. Now this is the new look of Modern Trader magazine. They've redone their magazine again. And I'm really happy about it. I don't care if you're an ETF trader, a derivative trader, individual stocks, if you're trading options on stocks, the VIX, this magazine really covers the gamut. And I have been a reader of theirs since their first issue. So I'm a nut with cars. I like so many things. But this is really a great magazine if you're a trader. So my advice to you, you can see what the new look is here, be it the calendars, the game theories, the industries you want to look at, commitment of traders. It's all there. And the articles are in-depth, most of them with charts and so on, to teach you ideas. It is not an op magazine. In other words, here's my opinion, do this. It's a teaching magazine. How do you get it? Well, you can go buy it from them, Or you can call us and you're going to get it for free for 1 year. And that's because we work with them. Give us a call. You can go to our website to sign up for it right here. It'll go anywhere in the world. We send these now by email, folks. If you go to them, you can get a print copy. It might be about $100. I think you can do well with this. And they put a new reader on it. And I think if you've ever heard Zino, Z-I-N-O, it works really well for this. You can also click up here. If you're watching me on YouTube, click that icon. You'll see the forms come up, or right below us. Again, just fill out all the information. We'll make sure that we forward it, and you'll start getting it from them by email. I'm Ira Epstein. You have a good day, and I will see you all later in the final video of the day.